everybody, I'm Dave Rotundo with ReMax First Choice, and today is a very special day. I am with Miss Mallory McGee Cooler. So Mallory, I have got a ton of questions. Look guys, I got a bunch for you, all righty? First one is, we're gonna break into FHA. This is the most commonly used one, the one I hear the most for. First, what is FHA?
Yeah, so FHA is a government-backed loan. It is sponsored by the Federal Housing Administration. A lot of people think that it is exclusively for first-time homebuyers, but that's not the case. It's really great for first-time homebuyers, but it's because it gives you a lower credit requirement as well as more flexibility on your debt-to-income ratio.
So when you say lower credit requirement, what exactly are you talking about?
So FHA, each loan's going to have their own credit requirements, but FHA, your minimum starting credit score is going to be a 580.
Wow. Okay, what is usually the normal? I mean, for most people and stuff like that are going to, I always hear like 640 and stuff, so 580 is pretty standard, so that's a pretty good shot. Here's a prime example right now. Rates have gone up, and right now we're going into a lot of people that are like, I can't afford these payments, so they want to put $10,000 down, you know, to lower that payment. $10,000 isn't making that much of a change. What options do we have?
Sure. So there's three main areas where you want to think about your, I guess, out-of-pocket expenses. So you're going to have your down payment, which is your principal investment in the amount that you're borrowing. You're going to have your closing costs, which are things like your appraisal fee, your attorney fees, anything that the state of Georgia takes, because you know, anytime you buy a property, state of Georgia is going to take a little piece of it, your tax transfer fees, any of the things that go towards getting the loan finished or completed. It's also going to have your escrow account in there, which I'm sure we'll talk about.
Part of your closing costs actually can do with that rate. So whenever we're looking at your mortgage payment, we're looking at 4 different variables. You got your principal, you got your interest, you got your taxes, and you got your insurance. So we call it PITI, P-I-T-I. So P-I, principal and interest, that's going to be locked in the whole duration of the loan. I hear people talking about, my mortgage just went up. How can that be?
So when you have a fixed rate mortgage, you are absolutely correct. Your principal and your interest portion are never going to change. Where people will see the fluctuation is in your homeowner's insurance premium and in your property taxes.
Oh yeah.
So one of the ways you can kind of offset that is by filing for the homestead exemption. Talk to your closing attorney about that, talk to your lender, talk to your realtor. They can always walk you through how to do that. And then as far as homeowners insurance, your insurance companies usually think that they're doing you a little bit of a favor by helping to increase your coverage every year because property values tend to go up. So if you're seeing an increase in your monthly mortgage payments, reach out to your homeowner's insurance company, ask them, hey, what's going on with my policy? Is it any different? Maybe redo an estimated replacement cost with them. See if your property value and your coverage are still in line. But that's usually where people see their changes.
Okay, gotcha. So I'm coming to you and I'm going to buy a house. And I'm going to use this example. And I've got, let's just say, $20,000. And I want my payment to be XXX. And I say, okay, my closing costs and my down payment is going to cover $15,000 of it. That extra $5,000, where would be the best place for me to put that if I want a lower payment?
If you are looking for a place to put that extra $5 in a way that's going to benefit you long term, instead of putting it towards your down payment, because that's stretched over 30 years, the biggest impact you're going to see is by buying down the rate.
Huh?
So buying down the rate, that's paying points. Investors come to the market, they say, hey, here's an interest rate, I'll offer it to you for this much, you don't owe me anything extra. If you want a lower rate, then there's a percentage of your purchase price that's charged, and it's collected at closing to, let's say, if you want to be at a 6.5 and the rate of the day is 6.875, well, you can pay an extra $1,000 at closing if that's the amount or the percentage for the points, and then you lock in that lower rate for the lifetime of your loan.
Really? So let me ask you this. Now, I've always heard this math, and you help me if I'm right or if I'm wrong. So for every 100,000, 1 percentage point is $1,000 per year. Is that correct?
Correct.
So broken over 12 months, that comes out to, what is that, $88 a month? Roughly. So $88 a month just by buying down 1 whole percentage point per 100,000. Guys, our housing market's at 300,000 is the median. Actually, I think it's around 340 right now. we're looking at that times 3. So that's a lot of savings.
When on average, most people recuperate the amount that they spent at closing within the first 2 to 3 years of their mortgage. So bringing a little bit of extra up front saves you after 2 to 3 years, and you've got the whole loan for 30.
Gotcha. Well, I'm a big fan of Dave Ramsey. All righty, he's helped me out a lot. There is one thing that I tell everybody: if they make just one extra payment a year towards principal, can you help walk us through that, what that does?
Of course. So making one extra payment or even multiple extra payments a year is always going to be better for you in the long run. But roughly, good rule of thumb is one extra mortgage payment a year shortens the life of your loan by 3 years. So you take a 30-year mortgage, you make it a 27-year mortgage.
Okay. So, wow, the faster you get to that principal, the faster you can knock that thing off. All right. So now we've talked about that. You know, we got all these things that we can buy, but what can we buy? I mean, can we only buy a certain house in a certain place? I mean, where can we buy? What can we buy?
So FHA doesn't have any location restrictions. Property quality is going to be the biggest hurdle with FHA, just making sure that you're finding a house that's move-in ready, it meets all of the safety standards, not necessarily like a fixer-upper. But as far as the type of the property, you're looking at single family, you can purchase a condo, a townhome, you could do manufactured, and you can even do a multifamily home up to 4 units. Anything over 4, then you get into the commercial territory.
Okay. Well, now you got me thinking about that one, but I'm going back over to manufactured, because I get a lot of different verbiage as far as that's manufactured, that's mobile, that's manufactured, that's mobile. I've always been brought up, basically a manufactured house came on the back of a truck and it got dropped in place. Mobile came on wheels. So essentially they took out the axle and they took off the tongue. So what's the difference?
So a lot of people use manufactured and mobile homes interchangeably, but there's a really distinct difference. So the way lenders look at a manufactured home that we are able to do financing for is a property that is permanently affixed to a solid foundation. So it becomes real property instead of something that can be picked up and moved over to grandma's house down the road.
It sounds all fancy and stuff like that, and our median house price here is right around $340,000. How much money can I borrow?
So FHA does have limits depending on which county you're in. Easiest way to find that out is to reach out to your local lender, tell them what county you're looking to buy in, and they can let you know what your purchasing power can be. But roughly you want to stay a little under the $500,000 range for FHA.
That's a nice house right there. I'm liking this part even better. So, wow, we've covered so many different things, and guys, I can't tell you. I mean, Mallory is just a wealth of knowledge, and one thing I do have, Mallory, I go through a lot of people trying to find it. Everyone's deciding this or that, vanilla, chocolate, strawberry, all these different flavors. Whenever you're looking at people, do you see the same thing or do you see like differences as far as like, I hear a lot of people get a lot of good advice from friends that mean well, but sometimes it might not be pertaining to their particular situation. Do you have any advice or recommendations for that?
Absolutely. So just remember, everybody is like a jelly bean. There's a million different flavors you can pick from. Everybody's got a different history. Everybody's got a different financial background, credit background, asset background, resource background. So keeping in mind that the loan can be tailored to your specific situation is a really good thing to keep top of mind. And then also ask questions. The best thing that you can do is ask a question, and the only silly questions are the ones you don't ask. All right, and that's all she wrote, folks. Dave, thank you so much for having me here. It's been such a pleasure to get together with you and just talk about something that we are so passionate about, which is helping people find their homes.
Mallory, thank you so much. Guys, that was so much information, and Mallory's available. Please give her a call. Give me a call.
Oh, thank you so much for having me, Dave. It's been an absolute pleasure. And if you do have any questions, you're welcome to reach out to me anytime.
Love you guys. Bye.